Hello and welcome to Money Sense. I hope you have had a really good week, although it's been somewhat challenging with the news with all these new variants of COVID-19 that are popping up all over the globe. As I mentioned in an earlier video, I've spent my entire career in biotech, over 32 years, and my current employer was the first to bring an antiviral for COVID-19 onto the market, which is remdesivir. And this issue has affected so many of us globally. We are hoping that these variants do not impact the efficacy of the vaccines that are available. We'll have to wait and see. Now, as for the stock market, I have been trading for over 20 years, and I've had my fair share of involvement in a number of crashes. The March and April year 2000 crash of the NASDAQ, the September-October crash of the entire market, which was in 2008, the flash crash of May of 2010, the September-October major correction, and then I call it a crash in December of 2018, and then the February and March crash of 2020. In all of those events, the market gave off some flares. And that's not to say that I know when a crash is going to occur. I don't. But I read the tea leaves. And right now what I'm seeing is a caution flag going up.
Danger, Will Robinson. Danger. No, Will Robinson. Danger.
Which is making me more risk off than risk on. And I want to share that with you today so that you can make adjustments to your portfolio in response to what's happening under the hood of the market. So let's get right into it. Hi, and welcome back to Money Sense. First, I want to give a shout out and thank you to my subscribers for this channel. It means a lot to me that you take time out of your day to watch these videos and share them with your friends. I really appreciate that. And it's my intent to give you something that will help you build your wealth. Now, as I mentioned earlier, I have traded for over 20 years and I have been involved with a number of what I would call severe market downturns and a couple of down and out crashes where the market just was in free fall. And in all of those situations, either a few weeks and sometimes a few months before the event, a flare or two went off that basically sent a warning signal that something was about to change with respect to the trend of the market and also the volatility level. And there are 5 things right now I think are starting to make me a little bit more uncomfortable being on the risk on side, which is long the market, versus pulling back and staying in a cash position, being more risk off. And those 5 things are margin debt being at an all-time high, call buying at an all-time high, almost 10% of the total volume of the New York Stock Exchange. Insider selling is at a ratio not seen since 1988. Liquidation breaks. These are starting to happen in the middle of the day, early part of the trading day, sometimes late in the day with no news event at all to give any explanation of why these sharp drops of a couple hundred points in the Dow and then a recovery are happening. And I've seen that before. And then last is the elevated VIX. The VIX has never, in my 20 plus years of trading, ever been this elevated for this long of a period of time. When I say elevated, I'm talking about over 20. But again, as the market has marched higher, the VIX has sort of flatlined around the 20s. So I'm going to spend a few minutes going through each of these things and just giving you my perspective as to why they may be a signal that the market is about to turn and possibly have a pretty strong correction in the weeks or months ahead. Now, just because there's these flares going up from the market, it doesn't mean that one of these is going to happen. Yes, this is from 1929, October 24th. Maybe, but maybe not. But I will say this, that right now what's happening is a bit bearish. And, you don't want to be chased by bears, especially if you're skiing, like happened to this guy. That was a bit unsettling, I'm sure, for him. He was smart enough to toss the bear his backpack so he could ski away to safety. First, let's talk about margin debt. As you can see here, it's at an all-time high of nearly $760 billion. This has never happened before, ever. And why is margin debt a big deal? Well, because here's what happens. If the market starts to drop and those who are leveraged long with margin suddenly see their stocks falling, and so they have to sell them because they get the margin call. And if they bought the stocks at a higher price than they currently are on margin, you're in a pickle. Say you paid $120 a share for a stock on margin, it drops to 95 overnight because of the futures being limit down, which means it opens at like $95. You're now 25 in the hole, so you get panicked and you sell. You've just lost 25 a share on margin. So you had to pay the margin interest, then you get the margin call from the broker. And in many cases, there have been times in past crashes where people not only lost all their capital that they had in their trading account, but now they owe the broker because they borrowed money on stock that dropped. So you basically are paying money for something you never really had. And when I see margin debt, like you see here, this is just really a major warning bell to me that we are entering a phase of unbelievable euphoria and greed when there's this level of margin debt currently in the market. So keep an eye on that. There's a link in the description below of this video to everything I'm going to share today to help you with the bull bear case, right? Because really, for my style of trading, sometimes I'm a bull, sometimes I'm a bear, but I don't want to be a pig. What's a pig? Well, a pig is the person that is greedy. They never sell, or they always short. They're never able to follow the trends of the market. They're either always a bull or they're always a bear. You've heard of those perma bears, perma bulls. They tend to not do well in the market. They're kind of like the pigs. They just can't seem to adjust to the trends. And pigs get slaughtered, sorry to say. So the second thing that I'm seeing is the call buying. Now, call buying is just gone parabolic. And you can see it here in this graph. This is just about, a week or two ago. This is a source here from Deutsche Bank. And you just can see that we have seen a level of call buying I have never seen in my life. In fact, back in August, late August, this started to elevate to a point that I had never seen up to that juncture. And of course, we had the 10% sell-off in the NASDAQ in early September. Now we're seeing this broad-based call buying at elevated levels never recorded before across the entire major exchanges. So the New York Stock Exchange as well as the NASDAQ. So this is cause for concern when you see that much speculation on the call side versus the put side. And there is a put-call ratio that you can follow. And generally, when it reaches a certain point where there's far more calls than puts being traded, that's indicative of market tops in general. And the opposite is true. When there is a high level of puts being traded from a ratio to calls, that could be indicative of a bottom in the market. Now, I'd like to take a pause here and just ask you to do me a quick favor and just smash the like button. It helps with the YouTube algorithm, and it gets my video into the hands of people that might be thinking about being more risk off and were wondering if there's something happening under the hood of the market that may be indicative of a coming correction or possibly even a crash. Now, another thing that's happening is insider selling is at a ratio that's not been seen since 1988, which is kind of surprising to me because that was the year after the 87 crash, and perhaps maybe people were still spooked at the time. But it's now, as you can see here, 1,000 shares are being sold to 128 being bought. So that's pretty significant to me that insiders who are in the know of their own companies are predominantly selling their shares at a 1,000 to 128 ratio. That's almost 1 in 10. So one share being bought for every 10 being sold. That's a pretty big flare to me, something you might want to be cognizant of and follow. The next one, which is number 4, is liquidation breaks. What is a liquidation break? Well, basically it's when a large fund, could be a mutual fund, could be a hedge fund, or someone who has a very large position of stock across multiple companies suddenly just dumps their position. They throw it on the exchange to sell. Now, stock markets, whether they be the NASDAQ or the NYSE, are auctions. That's really what they are. There's a bid, there's an ask, and market tops tend to happen when there's just no more buyers, right? If you go to an auction for automobiles, right, eventually the car that keeps getting bid up, suddenly there's only 3 people bidding on it, then there's only 2, then there's only 1, and then no one wants to bid any higher for that car, and it gets sold. The same thing happens in the stock market. When stocks reach a certain point, there's an exhaustion of buyers. And that's what causes these flares to go up, because certain things start to happen, such as liquidation breaks. This is when out of nowhere, the Dow, the S&P, and the NASDAQ all fall in unison, usually 1%, 1.5%, with no news event to coincide with. For example, if there was a missile attack on a US embassy or something, you get an initial shock to the market that might recover quickly. Or we find out there's a new COVID variant that's resistant to the vaccines. We would see an immediate drop in the market, probably a recovery in a couple of days. But these liquidation breaks, such as happened this past week, they just sort of happen out of nowhere. They have no news event to, point to, yet the recovery usually happens at the end of the day, but never back to the former high. One of the most significant liquidation breaks that I ever witnessed was in February of 2020, and it was on the 20th. It was around 11:15 in the morning. Suddenly, the entire stock market, Dow, S&P, and NASDAQ, just started falling. And there was no news event. I was scouring Bloomberg, AP, Reuters, couldn't find anything. And then the market just kind of recovered by the end of the day, but not quite at its highs. And the Dow finished down, I think, 128 points. That was February 20th. From the 21st of February until March 18th, we know what happened. The Dow dropped almost 11,000 points. So these types of liquidation breaks, when you start to see them happening more often with no news event to go with them, that's showing that some of the big fish are leaving the pond. And I saw this a lot in January, February of the year 2000, just before the NASDAQ imploded in March and April. I was seeing these same sort of liquidation breaks happen out of nowhere. And that was a signal at that time that some of the bigger, more in the know fish, you might say, were exiting the pond. So keep an eye on those liquidation breaks as you're doing your trading. And if there's no news event, it could be a signal that something's about to happen. The last one I want to mention is the VIX. Now, we know the VIX is the fear gauge, and it is measured by the amount of people that are buying put options and shorting the market, betting on the market going down. But in 20 plus years of trading, I have never seen the VIX stay elevated above 20 for as long as it has since the recovery off the March lows. And if you look at this chart of the VIX, you can clearly see it just is hovering right around that 20 to 22 level. And that tells me that there's something not quite right under the hood, because we are hitting all new highs on lower momentum, which is another signal I'm not going to get into in this video because there's a lot on momentum indicators. That's probably a whole video in itself, momentum indicators. But this is something that I'm really puzzled by myself, is why that VIX is staying elevated. And to me, it indicates that something's not quite right here. Yes, I understand the pandemic's going on, but if all is well under the hood of the market, then volatility would be falling back to historic levels, which is between 11 and 14, especially during all-time highs of a bull market. So with that, I want to thank you so much for watching Money Sense. It's my aim to give you information to help you with your wealth management and trading strategies, as well as building your investment portfolio. And again, I wish you a great weekend. Thanks for watching, and I'll see you in the next video. Be well and prosper.